On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Rob Thummel. He is the Senior Portfolio Manager and Energy Expert at Tortoise Capital, and he is joining me today from his brand new television studios. Rob, welcome to the program. We got to talk about oil. Over the last 5 trading days, we've seen oil spike over 9%. I imagine a lot of this has to do with the geopolitical events that are taking place, but is this run-up what we should be expecting for the rest of the year?
Yeah, Todd, you're exactly right. I mean, so the geopolitical risk premium in oil is coming back, right? So last year oil was down, 20%. The geopolitical risk premium in oil prices pretty much had evaporated. Obviously, you turn the calendar. We've got Maduro being and Venezuela happening, and then now you've got Iran and tensions heating up in the Middle East and Iran. You've got Maduro captured, and so what you've seen is this geopolitical risk premium in oil start to build back in, and so that's why we've seen oil, off to at least from a price perspective, a decent start to start 2026.
So there is a sense from the EIA that we were going to have an oversupply, which should have really pushed prices even lower. But with that, the supply doesn't change, though, even with the geopolitical events. I mean, it seems like this is just a quick trade to run up and then go lower again once things settle down. I mean, is that of your belief, or have you sided with the OPEC side where they're saying demand is actually going to exceed supply this year?
So that could happen, Todd, and that's usually what the cure to low prices is the old adage in energy: the cure to low prices, because that boosts demand, and I think we will see a boost in demand. However, the supply is the bigger concern, because you're right, as you stated from the beginning, we are in an oversupplied oil market at the present time, and there's going to have to be some adjustments made, and U.S. producers are probably going to produce less and not have as much growth this year, and we'll have a boost in demand, and so that'll all help balance all of that out. But the concern, at least in the near term, is, okay, it's not really Venezuela, it's more Iran, and it's more the Strait of Hormuz. And because as you know, that's a small strait, basically, where 25% of the world's energy travels through every single day. And so if there was any disruption that Iran, and because of the geography, Iran is so close to the Strait of Hormuz. If Iran does anything to the Strait of Hormuz to disrupt that supply, this oversupplied market becomes very quickly an undersupplied market. We don't see that happening, but that's just what the oil markets are pricing in slightly.
And that's on the Strait of Hormuz. But if you have, I mean, and I've gotten into trouble saying this before, it's actually a very enviable business model, because the Iranians could theoretically launch a Scud missile here or there. It spikes oil even higher. They're making even more money. How influential is Iranian oil? I mean, do they have a large market share at this time?
Not Iranian oil in particular, but that strait is really important, right? Because that's where all the OPEC oil is coming through for the most part. And it would take some, so the way we look at it, I mean, if the strait, if there was a, I'm not going to call it permanent, but a long-term blockage of the Strait of Hormuz by Iran, and that would be the biggest way that they could impact oil prices. Oil prices would temporarily rise to $100 plus. Now, I think they would eventually come back down, but there's no doubt you would see a immediate spike if the Strait of Hormuz was blocked for, let's just say, an extended period of time.
Okay, so let's turn the page to equities then in the oil sector. Now, right now, the big three are doing quite well. Exxon has been performing very well since the Maduro takeover. So where do we stand, or where are you looking right now? Do you think that the concentration should be that broad with the bigger oil companies, or would you like to break it down more of a micro level, maybe to a Valero Energy at this time?
Yeah, so for us, who wins from increased Venezuelan oil? Probably absolutely the refiners win, because now there's another source of this refinery type oil, heavy oil that they can access, so that their costs will probably come down. So the margins of companies like Valero, like Marathon Petroleum, like Phillips 66 will probably be higher for longer, and so they'll generate a lot more free cash flow. At Tortoise, from an energy perspective, and we look longer term, from a longer term perspective, a couple things we like. we like natural gas a lot because we think that, electricity is actually becoming the new oil. And we can talk a little bit about that if you want, but the electricity is going to become the new oil because the electricity is basically going to be the thing that we need for this new AI future economy or this AI industrial revolution or whatever you want to call it. And so what is the fuel supply source to generate that electricity? Well, we think it's going to be natural gas and nuclear. And so that's what we're excited about when you look at just the energy sector in particular.
Well, that's a good segue. So let's start talking about electricity then. You brought this up before on the Money Path, how this is now one of your favorites, if not the favorite for this year and maybe even beyond because of the AI data centers, et cetera. The need for electricity is greater than it's ever has been. What are some plays right now, though, that Tortoise is concentrating on when it comes to investing in that area?
Yeah, well, from an electricity perspective, so we like up and down the value chain. So you can start with like some of these independent power producers, like Vistra Corporation or Constellation Energy, right? That are producing a lot of electricity in the regions where you're seeing a rise in data centers. We have a company here right in our backyard, Evergy. It's our local utility, but Kansas City actually has become a spot where they're building some data centers. And so, you're all of these various, whether they're independent power producers or they're electricity providers, they're really transforming their business to really adapt for this increase in demand for electricity. So maybe they have to build some more electricity as well. Maybe they have to come up with clever rate structures so that the key here is that the ratepayers don't have to pay for this expansion, that the actual mega cap tech have done that. Williams is another classic example, Todd, of this concept of behind the meter. I don't know if you've heard of it and your listeners have listened or heard about it. President Trump talked about it yesterday. About we need to keep electricity prices low. Behind the meter is one of the ways to do that. What Williams is doing, Williams Companies, and one of our largest holdings across all of our Tortoise platforms, what they do is they are the largest natural gas pipeline network in the world. They're actually building electric generation in New Albany, Ohio, to help Meta or to support Meta's Socrates data center campus there. And so Williams is going to build electric generation and utilize natural gas and their pipeline infrastructure. And we think examples like that will accomplish exactly what President Trump and all of us really want. We want the mega cap techs really to pay for the expansion of the data centers, not necessarily us as the retail consumer.
Well, I get that, and that has been a discussion because, especially when it comes to electricity prices, should the AI data centers be taking more of the I guess a larger expense because you can't pass that on to just the American household. But where's the electricity coming from? I mean, that's where I'm confused because
Yeah.
in New York you have Niagara Falls, it produces electricity. You got the dam in Las Vegas. You have these nuclear plants, but we're not building new nuclear plants. I mean, is there another source that's creating the electricity?
Well, not building new electricity, actually, Todd. So that's why we like natural gas because really still the most economic source of clean electricity is still is natural gas, right? And as a fuel source. And so we've got a lot of natural gas in the U.S. And one of the reasons why the U.S. has been able to really win the AI race right now globally is because U.S. electricity prices are significantly lower than, for the most part, anywhere in the world, especially Europe. And so yeah, we'll continue to build more natural gas. Now, nuclear will play a role. You mentioned nuclear. They're restarting a lot of these old nuclear facilities. 3 Mile Island. There's Palisade Park in Michigan. There's a couple others that they're gonna basically bring these back to operational capacity, and then we'll see down the road. Maybe we'll have these small modular nuclear reactors down the road beyond 2030. But in the meantime, basically we're going to need an all the above approach in the near term. So we're going to need natural gas, nuclear, probably even some coal, and not turn off all of the coal. We're going to need some wind and solar as well, and battery storage. So this electricity theme and electricity becoming the new oil is a massive opportunity from an investment perspective, we think, and it's going to require massive investment as well.
So you see that you're bullish on the electricity sector, not just for the remaining part of this decade, but even next decade, it sounds like. Is that true?
Yeah, no, right. That's right, Todd. Because if your listeners haven't looked at it, I would really encourage them to look back or look at the forecasts of growth for electricity. So for the last 20 years, it's been zero. I mean, the demand growth in the U.S. has been zero. Now for the next 20 years, it could be 2 to 3%. Now you say, 2 to 3%. What does that mean? Well, when you compound that over a 20-year period, that's a lot of growth. So that's a lot of electricity, and that's a lot of cash flow. And the great thing about electricity companies, and we capture a lot of those in our Tortoise Electrification Infrastructure ETF. Those companies are dividend payers. They operate real assets, and we see them continuing to be able to grow their asset base, grow their cash flows, and increase their payouts to shareholders that we can turn around and pay in the form of dividends out of our active ETF.
So tell us a little bit about the electricity ETF then at Tortoise. I mean, what's their performance? Can you give the audience some numbers?
Yeah. Well, we had a pretty good year yet last year. I don't have the numbers right off the top of my head, but the Tortoise Electrification ETF is out there, and it's on our website at tortoisecapital.com. You can see all the specifics on the fact sheet, and we keep that updated. So its focus though is on this electrification theme, and it's probably one of the few products out there at least that I've seen, that really captures the opportunities in electricity, with electricity becoming the new oil, and then these electric generation companies, and these transmission companies, and some of the infrastructure companies as well. And we also throw in a little bit of energy exports in there as well, because those are two of the big macro mega trends that we see playing out really over, as you highlight, not just a few years, but several decades.
So, as an exporter, during the first Trump administration, the Interior Department talked about how much natural gas we have off of our shores. Apparently, we have enough to heat every home in America for the next 10 years. If that's the case, do you see more Interior Department approvals for companies to go
Yep.
and extract this natural gas and then therefore helping us export it out around the world?
Yeah, no, that's a very good question. So I think the U.S. is, as you know, the largest energy producer in the world, and actually it's the largest energy exporter in the world. And if you think about what liquefied natural gas exports have done for countries like Europe, it's become pretty important, because obviously Europe relies a lot less on Russia today than they have in the past, and especially after the Russian invasion of Ukraine. U.S. LNG saved the day in Europe because it was able to get a really important commodity to Europe. I do see U.S. LNG, and as you highlight, because of the vast resource, because of all these shale wells, shale oil and gas drilling that we've done over the years, and the efficiencies that continue to happen, we can continue in the U.S. to produce low cost natural gas and other low cost energy products like oil, and we'll export them to countries all over the world. And I think will continue to be an increased demand for U.S. Energy products, especially now, even with these things with Venezuela going on, or Iran, or Russia previously. I mean, I think other countries around the world want secure energy supply sources, and everybody recognizes that. Look, we're the opportunity, we're blessed in the U.S. because we don't have to rely on other countries to provide our energy supply sources. For the most part, we have them all right here, and all of our oil and gas producers in the U.S. do a fine job of helping us, have helped us make us energy independent, and that's a really, really important point. And it's also a real advantage, right? It's a real competitive advantage for the U.S., and I don't think that will change.
No, that's great, and you're absolutely right with our advantage around the world here in the USA. The one final question before we conclude the show. I want to get your opinion on renewable energy, because there is still this push of taking anything from everything from windmills, which the president recently said he'll never put up a windmill, and then you have taking cooking oil, used cooking oil, and refining it, making it
Yeah.
into some other biodiesel fuel.
Yep.
So, do you? These seem to be fads, and we heard this with the E85 with ethanol a couple of decades ago. We did, but we haven't. You haven't seen these renewables really capture the interests and therefore maybe replace something like oil. Do you ever see this changing in the country? Because there is a threat that we will run out of oil, but something has to occur. And if so, what is it going to be?
Yeah, no, that's a good question, Todd. You at the beginning you referred to us here at Tortoise as kind of the energy experts, and we've got
Yeah.
a team here. My fellow portfolio managers and I, we've been looking at this sector for 20 years plus, and we look at all energy technologies, and we've seen, and we always do. We're always looking for that exact answer is to your question. So we looked at heating oil, or sorry, cooking oil. I mean, converting it to renewable diesel, as you highlight. We've been part of the ethanol trade. So what's going to happen? I mean, it all comes back down. It really just comes back to economics, right? And so renewable diesel is just not that economic. Wind energy, solar energy is not that economic. So you need tax credits, at least from the renewable side, to support these various renewable projects. So what I think what we've come to is, you know what? We don't have to make it that hard. We've got some great natural gas, and obviously there's some fantastic environmental benefits of wind and solar, and even reusing and recycling things like cooking oil. But oh, by the way, natural gas is really, really environmentally friendly as well. If you just look at the emissions, and the proof is in just look at global emissions, or U.S. emissions. U.S. emissions have declined 20% since 2005, and natural gas has gained market share in generating electricity and replaced coal from 2005, and really taken over and become the largest energy supply source. Emissions have declined accordingly. If we keep doing that. That's going to help as well. And then, oh, by the way, if other countries like China and India follow the same playbook that the U.S. has, and back to your original point, we're going to have to export a lot more U.S. natural gas. We have it, but that would decrease global emissions as well significantly. And that's probably the best opportunity that not just the U.S. but the world has to improve the environmental footprint and reduce global carbon emissions.
Well, that's interesting. Well, I know I'll have you back on the show to talk about this later on, and we'll see if some of these items can actually come true for the world. So, but that remains to be seen. But Rob, I want to thank you for joining me today. You guys are the energy experts at Tortoise Capital. You're our energy aficionado here at BTT, and I can't wait to have you back on.
Thanks for having me, Todd.
Absolutely. So on behalf of Rob Thummel, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Catch us at 2 o'clock today, 2 o'clock live, the debut of the Torres Report. Jose Torres, senior economist at Interactive Brokers, is going to have his show debut on BTT. We're going to break down everything that's taken place with Chairman Powell and the Fed. You definitely will not want to miss the debut episode. So until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.